too late to go to the bathroom.
Okay, good afternoon, everybody. Thanks for jumping on and joining us for the February technical luncheon. We got a few items to start before that meeting, and before we let Andrew present the visualization risk to reduce bias and improve decision making, my favorite diagrams. Before we do that, just give a shout out to the sponsors. Appreciate all their financial support and other support they provide to the society. And take a look at the next screenshot. Here's our next 3 upcoming monthly technical luncheons. So make note of those, and you'll see more emails and advertisements of those on LinkedIn as well. So keep an eye on that. And now I think Patrick or Cayman, our president's going to jump on and discuss the nominations for the House of Delegates, AEPG House of Delegates.
Thanks, Raleigh. Hey, good morning, everybody. For those that don't know, the Oklahoma City Geological Society is an affiliated society with the AEPG. And as an affiliated society, we have the right or the opportunity to nominate members to the AAPG House of Delegates. The amount of members that we can nominate is based on the size of our society, and we are eligible for 4 House Delegate representatives currently. They do that count just based on what's the number of society members that are also members of AAPG. So the more that are more folks that are members of both societies, the more delegates that we're eligible for. So, what is the House of Delegates, or what do you do on the House of Delegates, or how do you become eligible for the House of Delegates? So just some background information on that. The term if you were elected as a member of the House of Delegates or a delegate to the House of Delegates, the term lasts for 3 years. And it'll begin in July of this year. The requirements to be in the House of Delegates is that, or I guess the one major requirement is that you attend the annual AAPG convention and the House of Delegates meeting each year that occurs just before the AAPG convention starts. Additionally, as a member of the House of Delegates, you're there to represent our society, the Oklahoma City Geological Society, represent our society in relation to the AAPG, but you're also responsible for helping to guide AAPG. You're responsible for the bylaws or helping out to make amendments to the bylaws, voting on those amendments. So you have some part in the governing of AAPG. All of our delegates this year are, sometimes the delegates are staggered, but the way it's worked out over the years is all our delegates actually end their term this year. And so what I'd like to do is basically open up the floor for nominations for people who are interested in being in the AAPG House of Delegates that are members of the society and members of AAPG. The nomination list that we put together, what we'll do is put a bio together for everybody, and then we'll send out a vote to all the OCGS members and allow basically by popular vote to nominate the 4 House Delegate members. And then we'll assign some alternates or backups. Certainly 3 years can be a long time. And sometimes, as you guys know, the industry changes, or maybe things change in life that would redirect you or limit your ability to participate. So we also will assign backups if those House Delegate members are not able to participate going forward. Let me share my screen here with everybody. And I think everybody can see that there, my screen sharing of the current folks that make up the slate for the House of Delegates. So these are the individuals that have kind of reached out, or their peers have recommended that they are considered for the APG House of Delegates. So Raleigh Bloomstein, James Van Alstine, Drew Dressler, John Tellers, Joel Alberts, and Kurt Kohler, in no particular order, just kind of a list of the individuals there. And so what I would like to do is, these are 6 individuals we currently have on the slate, and I'd like to open up the floor to any individual or somebody who would like to nominate somebody for being in the House of Delegates. Jason Curry wrote in the chat, he said, what is the timeline for submitting? Our goal is to try to get our slate assembled by the end of this month, so in the next 2 weeks. We would hold the vote in March. By the end of March, hopefully have all those individuals, the vote tallies back in, and those individuals basically nominated or assigned to the APG House of Delegates. So if you're interested in participating or being a member on the slate, or being on the slate to be voted on, or somebody that you'd like to nominate, feel free to write your name in the chat there. If you want to think about it some more, kind of consider if that's something you'd like to be a part of, feel free to send myself an email or Michelle Hone an email. You can go to the ocgs.org website, and you can go in there and find our email addresses if you don't have those already. And so this, in my mind, this is a great opportunity. One, not only to kind of give back to our society, but also get involved in the APG. And it's, it was a great opportunity to kind of grow geosciences, especially in a time where, we're kind of seeing a shrinking industry and shrinking geoscientists out there. So it's a great way to kind of get involved, see if we can help drive some excitement for both societies, both organizations out there. So I'll leave it right there. I'll turn it back over to Raleigh. Again, if you're interested in being on the House of Delegates, we would be happy to have. We'd be happy to have anybody throw their name in the hat. There's a comment that I'll throw it out there. There's a comment that our list lacks diversity, and I would agree with that. And so I'd encourage people, if they're interested, to throw their name in the ring and see if we can increase the diversity of the list as well. Okay, Raleigh, go ahead. I'll back to you here.
Okay, thank you, Patrick. I just give everybody a fair warning. I've been dropped off twice for some reason. So if you lose me for a few seconds, just bear with me. I'll come back. All right, great. So today we have the special privilege of having Dr. Andrew Cullen present to us. Again, his talk is visualizing risk to reduce bias and improve decision making. My favorite diagrams. And I want to give you a little bit of information about Andrew and his work history, just in case you don't know him. And he didn't put in his personal passion, non-geologic passion in here, but he's also a rock star. So he may speak to that. But Andrew is currently the Senior Vice President of Geology at Warwick Investments Group. He's been in that position for over 6 years, and he's worked for over 40 years with professionally as a geologist, including working at Chesapeake, Shell International, EOG, Altex Oil, Clear Creek Silver Company, and Energy Reserves Group with the Minerals Division. So he holds a BS, MS, and PhD degrees from the University of Oklahoma and the University of Oregon. He's the first author of more than a dozen peer-reviewed publications, primarily from field-based studies in Borneo, Papua New Guinea, the Galapagos Islands, and Oklahoma. So the most exotic being Oklahoma. Dr. Cullen is currently an adjunct professor at the University of Oklahoma and the College of Law. He's the former chair of the Alumni Advisory Council for the OU School of Geosciences and has served in the OCGS's board of directors. Since moving back to Oklahoma 10 years ago, Dr. Cullen has contributed more than 20 short technical articles to the Society's bi-monthly magazine, The Shale Shaker. He's been a reviewer for AAPG Grants and Aid program for 15 years. Was an invited speaker in AAPG's Playmaker Forum and was co-organizer of a Hedberg conference on tropical deltas. In the last 2 years, Andrew has reviewed submittals to the Journal of Asian Earth Sciences, Tectonics, and Earth Science Reviews. His current research is focused on evidence of volcanic triggering of the late Devonian mass extinctions in the Woodford Shale, reinterpretations of the Muir Fault in southwest Oklahoma, and new play development in southeast Oklahoma. So Andrew's been very active over these last 40 years, and he's going to share some of his wisdom today. So Andrew, with that, I hand it over to you.
Okay, now let's see. I just put my slides on slideshow.
I think you got to share your screen still, or share your app.
Okay, let's see. Where is the share? Share. Share screen. Spinning, spinning, spinning. Can you see it?
Not yet.
Yeah, just have a big spinning, acts like it wants to. Let's see, about entire screen. Any better?
No, not yet.
Share. Let's try. Share. Share screen. Just sits there and spins.
Do you have a single monitor screen or a double monitor screen?
Single.
Single, okay.
And I can't even unmute. Wait a minute, we got something. Wait for it. Andrew, can you try and email it to me? Or is it too big?
Way too big.
Oh, okay. You may have to go the PDF route.
Hummer. This worked day before yesterday.
I know. Let me turn this one off. See if that helps.
So now you must authorize screen sharing. Okay. You were not able to enable screen sharing. Connected people. Phone settings. Okay, I'm saving it as a PDF because it looks like there's an option to share a PDF.
Okay. Hang in there, everyone.
Two. Okay. No, thank you. Okay, now. Synchronous that. Share PDF. Share PDF presentation. Okay, it's loading a PDF presentation. It's all in my nice fade-ins and all that. Will go away, so the slides will look busier than they should.
That's okay. We'll make do. I keep getting dropped and reconnected. I think that the internet provider is having some issues in this part of town today.
Yeah, I've got real low connectivity right now. But I do have power. Well, while this loads, I'll just talk about the presentation a little bit and the diagrams. And to some extent, I guess I've been around long enough. I'll probably, at the risk of grandfathering some of you, it's a collection of diagrams that I've found useful in both when I review work and discuss risk and how to assign probabilities, and to think about how we make decisions. And I'll give a shout out right now. So a lot of this conversations, both when I was at Chesapeake and since we both left, both Afshin Talsaz and David Hull. We've had over the years lots of interesting conversations on behavioral economics and things like that. A lot of things we tend not to think about as geologists. So let's see. So I choose this media. Let's try this. And how are we looking? Can you see it?
Yeah.
Yes.
Okay, we've lost some time, so Raleigh's already reviewed the title of the talk. Use the arrows. Excellent. Okay, we're going to follow this outline. I'm actually going to cover a little bit on portfolio theory, the efficient frontier, one of my favorite diagrams as well. Risk versus uncertainty, failure. What do we mean by failure? Success, technical versus commercial, log normal distributions, heuristics, little things that we learn to do very quickly that make decision making easier. Some traps around heuristics, prospect theory, and the four-corner diagram, the Maastricht template, and we're also going to cover the truth, lie, ignorance diagram, and we'll have some examples and close with a case study. So it's imperative that when allocating money, that decision makers have confidence in the quality and the consistency of the portfolio that they're trying to select. Now, a portfolio is a range of opportunities and investments. In portfolio theory, investors select investments that maximize their expected return at a given level of risk. And it can be used then also conversely to construct a portfolio that minimizes risk at an expected rate of return. So in visualizing portfolio theory, this goes back to Harry Markowitz in the early 50s when he was actually a student and wrote a paper that became the basis for his PhD and ultimately won the Nobel Prize in economics for developing portfolio theory. And the story goes that Milton Friedman was on his PhD committee when he presented and remarked it was so unusual. He said, "This is hardly economics." Of course, it goes on to garner a Nobel Prize. So the idea is that major oil companies and independents, all companies face choices in portfolio selection. And that there's, if we look at usually measured in volatility or standard deviation on the x-axis and some expected rate of return, which has a measure of risk in it, that there are a range of possibilities of different opportunities, but there's a limit, and also there's at any given level of risk, there's an optimal expected rate of return that one can seek. And then depending on the risk profile of the company and one's backers and investors, one selects hopefully the best expected rate of return at any given volatility of risk. So we could see two portfolios, A and B. B has the expected rate of return that is 7% higher than portfolio B, and we would choose portfolio A as fiduciaries. Risk versus uncertainty. We'll just say risk in this talk represents failure, and it results in loss or pain. Uncertainty is a measure of our confidence in the probability of an outcome, including failure. And volatility is a statistical distribution of a range of possible outcomes. So in these definitions, there is no, if there's no pain, then there really is no risk. If it doesn't cost you anything, and you're willing, failure is free, then it's really not risky. In most of us in the subsurface, our goal is to reduce the uncertainty by increasing our confidence around the data. And in a portfolio, the volatility is the aggregated variance of each investment. So one has to weigh the specifics of any particular investment in relationship to the other investments in that portfolio. Now, failure, I view these as critical risks. You fail if in unconventional and conventional plays, if certain key play elements are absent. So you all have to be present. So in conventional charge, reservoir, and I sometimes lump structure and seal together into trap, just so I only have three things to multiply. And in the unconventional world, charge, reservoir, and seal are similar, but they have slightly different seal. And unconventional, you want abounding mechanical variables. And the differences between these in conventional plays, timing and sequence is important. It's less so in unconventional plays. Now, spatially visualizing risk, we can map out individual risk segments. Those are on the left-hand side, so charge risk, reservoir risk, and trap risk, as to polygons that look down on the Earth. And if we overlay all those polygons and multiply the individual risks of the play elements, we get a total play risk. So you can see why I put trap risk as combined seal and structure, because the multiplication of these gets rather messy the more factors you add up, and the more your map starts looking like shattered glass. It should be remembered that the risk of a prospect within a play is both the play risk and the prospect risk. So if we were to drill in the fade-in, The black arrow, that initially carried a 0.6 chance. And we drill a well, it's successful, we proved up charge. Now we eliminate play risk, and we only have to put prospect risk in that play segment. So it's a nice way to visualize, spatially visualize risk. Now, Pete Rose gave me this coin. It is actually, and he joked, not the baseball player, but the risker for APG. I think he's a Powers Medal winner. Anyway, it's a binomial probability indicator. So on the left, here's a 50-50 chance. Heads is failure, tails is discovery. You can visualize this in another way. If we had 6 die, and what's the odds of rolling a 1, 2, 3, 4, 5, or 6? It's about 16.7%. So the probability of success and the probability of failures differs in these. In case of the dice, you have a much greater probability of failure. Now, in heuristics, it's very important how we frame problems. And people tend, if they're selling something, to frame something in terms of the success case. And, a 20% chance of success sounds much better than an 80% chance of failure. Outside the E&P business, this becomes really critical if you think about making medical decisions and how things are couched related to maybe having a brain surgery. Now, people have computed odds for quite some time, and there's an idea of utility theory. This goes back really to the early 1700s. Bernoulli cousins looked at people's decision making and realized that people weren't always rational, that we attach emotions and values to our decisions that don't necessarily reflect the absolute number you would expect from an expectation value. This was extended further by Daniel Kahneman and Amos Tversky, in 1979 when they published something called prospect theory. And in this, they take decision weights and how we weight our decisions around outcomes. And they've noticed with various experiments that there's an asymmetric aversion to loss. And really, at big gains and big losses, we become increasingly insensitive to those gains and losses. But there's an asymmetry to how we value this, and we tend to be risk averse. And the bottom line is, we're faced with a risky choice leading to gains. We're risk averse, preferring solutions that lead to lower expected value or utility, but with a higher certainty. And we'll look at that again in just a couple of minutes. So the second theory of prospect theory, part of it is that people attribute excessive weight to low probabilities and insufficient weight to things that have high probabilities. Now, they've actually done a whole sets of experiments, cleverly designed to come up with, I call it visualizing prospect theory. So on the horizontal axis is loss on the left and gain on the right. And then we have kind of utility on the vertical axis. You think of this as joy or pain. And there's a dollar amount assigned to this on the loss and gain. And you can see that the curve there is kind of S-shaped, so it's asymmetric. So on the gain portion, we become, in a way, the bigger the gain, we come, in a way, indifference to the amount. So if you've got a whole lot of money, right, and you want to, a $10 bet doesn't matter that much, or a $100 bet is probably less valued than if you don't have a lot of money and you're asked to bet $100 on a coin flip. Now, on the bottom left, we see this asymmetric aversion to loss, where it sweeps down, and we view loss, and studies have shown that we generally want compensated about 2 to 1 for loss over gain. But also, there's an increasingly indifference to loss. Whether you lose $10 million or $15 million, at some point, it just doesn't matter in your mind. Now from this, they constructed the fourfold pattern, and this is really quite interesting. And there's only two elements that we can possibly be. We can be risk-seeking or we are risk-averse. There's no other choice in this matter. So in the upper right-hand corner, this is we're risk-averse, and that's the probability of a big gain, but also a small probability of loss. And this is where we're willing to settle for less. A big lawsuit, now you've got a 90% chance of winning $100 million, but you've got a 10% chance of not winning. Would you settle for $85 million? And in general, people will settle for less. And this is called the certainty effect. The more certain the outcome, the more likely we are to choose that outcome. And in our business, a lot of times this is selling down on a good prospect. It might fail, so we're going to take a little bit of risk out of it. Now, on losses, if we go down, when we look at gains and we're risk-seeking, and we have a hope of a large gain, all right, the possibility of something great happening, but it's probably not going to happen. Now, this is the realm of lottery tickets. It's also, if we're constructing a portfolio, of why we sometimes take small interests in big prospects. Moving around to the lower left, we see that another risk-averse quadrant, and this is the fear of a large loss that has a low probability. This is why we buy insurance. Now, what is striking is we go to the high probability of a large loss, and we find that people are actually become risk-seeking. And it's because they're desperate. But they have the possibility, and this is the possibility effect, the possibility of the big win. We could get out of this. Maybe we'll break even. And this is also in some of the heuristics, this is also where we would start thinking about the sunk cost fallacy. We keep putting more money in because there's a chance we'll get all our money back. So if we think of this as a philosophy and we're making decisions, where we are in these diagrams is quite useful in discussion on decision making. So a lot of this comes with emotion, right? So you think of fear, regret, desperation, hope. These are all emotions that drive our decisions. And our emotions, by definition, are not rational. So if we think about a portfolio as being a collection of things that lie in all these different quadrants. So each part of a portfolio lies in a different part of a problem. If you want a diverse portfolio, you'll have a diverse set of things related to risk profiles, but they aggregate up to a single point on the expected return versus volatility. Now, we're all fairly familiar with the distributions, normal distributions, and logarithmic distributions. I just want to cover a bit that in the logarithmic distributions, log normal distributions, that things are skewed at the high end. And if you ever want to explain this to people, and an easy example is to take 3 dice. And if you add them together, the middle diagram is the sum of 3 dice, and it varies between 3 and 18. But we can see if we multiply those dice out, it's between 1 and 216. So there's a bigger scatter in the data, and there's a skewed distribution to high numbers. Now, when we multiply in the subsurface, thickness, area, porosity, et cetera, we're multiplying values, and so we get log normal distributions in the surface as outcomes. So the 3-die problem, that's the inset, those are the individuals. Now those are discrete values, right? You can't have a 2.5 on a dice. And so I've just dashed in a continuous function if we had actually variables in between. Now, if I were to just say I'm going to multiply those out and say the outcomes of multiplication represent volumes in a prospect and probability, that's the big graph. We can see that unrisked, in green, 100% out to the 216, a very low probability of finding the 216 million barrel prospect. Now, if we look and add risk to it, we would reshape that curve, fundamental distribution numbers stay the same, but it just takes on a different shape. And within all this, we have to ask ourselves, between technical success, that one of the foulest, most disappointing things we can have as explorers is the technical success, because we want to have a commercial success. And commercial success comes at a cutoff, and we can then use these curves to look at the probability of success at a given cutoff. And in this particular example, the probability of success commercial with a 40% chance on a prospect is about 10% at a 50 million barrel cutoff. So this just illustrates we have all these variables. It's the Monte Carlo method, where we take a distribution and we randomly sample that distribution. Naturally, the mean around the mean gets sampled more often. We multiply all of those out, then we get a probable volume distribution around this prospect. In this case, we've got a bit of four-way closure, and then we can risk the probability of fault seal down at the bottom, where we can see the volumes are low probability of fault seal, but we can easily double the volumes if fault seal works. How this is done, once things are aggregated, we make probability distribution functions. In this case, it's the area under the curve that matters. The probability of finding the exact value of the mean is really low, 50.77 million barrels versus 50.78. But we want a range in there, so what we'll do is then integrate under the area of a curve, and it starts telling us the probability of exceeding or not exceeding certain values. So what are some tools to help us with this? And the idea of risk aversion and emotion, back in 1000 AD, the moving finger writes, and having writ moves on, nor all thy piety nor wit shall lure it back to cancel half a line, nor all thy tears wash out a word of it. So we want to avoid bad decisions and tears. Probably the most powerful and easy to use is the Maastricht risking template. This was developed by Shell. Now, up the vertical axis is our confidence of our knowledge. In the horizontal, here's the probability of occurrence. So we can look at it 0 to 100, good news, bad news in the upper right-hand corner. And we can see that logically, there are areas in this diagram where you can't be. Up above, if I'm highly confident, perfect to very high confidence and knowledge, but I only have a 50% chance, well, that doesn't make any sense. How can I be confident and yet be so equivocal? Likewise, in the lower left and lower right-hand parts of the diagram, you can't have low confidence and still be highly certain. So there are areas of this diagram. So when you start thinking, and we'll look at some examples, but in risking committees and discussions, it's like, well, would you expect the values to be of this range? And you can start plotting based on your confidence and get a range of numbers that you could start putting in terms of your probabilities for risking. So this is a really powerful tool for interrogating decision-making and building distributions and the ranges of those distributions. Now, what's the goal, is to reduce risk and to increase confidence. So we want to know whether it's good news or bad news. And most of the subsurface data that we deal with, our decision-making is about moving up this diagram towards either bad news or good news. But we want to increase our knowledge and our confidence in decision-making. One of the traps here is so-called the confirmational bias, where we start looking for data that supports our position. We start looking for the good news data instead of having a balanced approach to seek out both sides of an argument. Now we can look at, there's another called the anchoring and the effect heuristic. So we'll look at the Indonesian deepwater bid round. This is up in the Bird's Head of Indonesia, the west half of Papua of New Guinea. And so there was a, I think about 2008 bid round. Onshore in the Bird's Head, there's a couple of really big gas fields, 7 TCF, 13 Verata. There's a kitchen that expels gas and migrates up into the prospects. These are Jurassic age reservoirs. There was a pretty good array of 2D data. We worked this, we identified, there were some shallow prospects, but none of them were big enough. So, first of all, we're remote, right? We're in the Bird's Head of Indonesia. We're 30 kilometers offshore from no infrastructure at all. It's going to take a big field. And we realized really about 3 TCF was probably the minimum commercial cutoff. And the only thing meeting that was a big closure, the only one in these blocks. You hate bidding on the only one, but it was a big closure, and we call this Econ Hebot, which is Bahasa, it means big fish. Econ is fish. Now the team brought in data from Australia. The closest well was roughly 50 miles away. There was one. It was on an uplifted block, maybe not very representative. And what as we worked through the data, we were fairly confident of structure. We had a reasonably good shot at charge, but we really weren't sure of reservoir and reservoir quality. And this boiled down to the fact that the Jurassic was fairly deeply buried at 4,500 meters below mudline, the porosity of 8%. Now, this resulted in a rather unfavorable view of the economics. Now, the business opportunity manager, I mentioned that if this project went forward, he had a very good chance of, this would have been a new country entry, and of becoming the exploration manager, getting a promotion, and moving to Jakarta. So he's got a motivation and pushed back on the technical evaluation, thinking we had the Jurassic too deep, and pointing out that the closest Jurassic field in orange here fell well off this trend. And so the challenge was laid out, have you anchored? How confident are you? We had to admit, we listened to the argument, and we said, let's go back and sharpen our pencils. We'll look at the velocity data better on the right over the prospect rather than all the velocity data. And so we went back and realized that there was a little bit of wiggle room to adjust some of the numbers. And that's just what we did. And when we did, we went from the first pass, we had the probability of commercial success at 7% and an expected monetary value of minus $50 million. Now, this is a $1.5 billion project by the time this would have been LNG trains onshore in a remote region. So 50 million isn't much, but it was, we couldn't take it to bid. We did the second pass prospect, and lo and behold, we got the probability of commercial success up to 11%. But this was enough to move it into positive EMV territory. We bid. Shell should have won the bid according to the criteria set out for the weightings of number of wells, work program, and bonus. But Hess won the bid. They bid a much bigger cash bonus, even though it was supposed to be weighted. I know the geologist at Hess that worked this up and actually sat the well and looked at it. And the bottom line is they drilled this well. It came in. They never reached the Jurassic. It was very hot, and small sands they found were tight. So the initial evaluation was correct. Shell was offered to come into the well, but we decided not to. And in this case, it was a good decision. Even though we look back, we think we had it risked relatively well. Hey, which way is the bus going? East or west? Now, there should be a fade in here. Right? What I didn't tell you is what country are you in? Wouldn't you like to know that? So this is that thinking fast. You know, we're in the United States. You look at the bus. Oh, I'm in the United States. But there's often big pieces of information that we forget to ask for. In the USA, I think the bus is going to be right. Think about it. Here's another example of reservoir prediction. This is the overconfidence bias. Now, I reviewed this prospect, and an experienced interpreter had the probability of reservoir at prospect B at 60%. This was on the basis of around A, there's a set of fields, proven reservoir. You can see then the 200-meter isobath. So this is a deep water fold thrust belt. This is the island of Borneo. And we came in to review the prospect, big field discoveries. What could go wrong? Here's a couple seismic lines. So the discoveries up there, there's over 1 billion barrels recoverable in a set of fields in these toe thrust anticlines outboard of the Barham Delta. Interestingly, the Barham Delta is dominated by counter-regional faults, but here as we move further to the southeast, to the proposed locations, we see now down to the base of normal faults. There's the prospect location. And here, rather than thrust faults and toe thrusts, it looks like we're more dominated by symmetric detached folds. Now, this favors these detached folds geomechanically tend to form in more shaly sets of reservoirs. If we look at a regional basis of prospect A and B, in the green on the right, the map, that's the so-called Crocker sandstone, and it's been uplifted. And as we move, there's a big area onshore in the gray dash patterns that's an Oligocene shale. So we can see the hinterland of B is dominated by the Setup shale, and A is dominated by the Crocker sandstone. And it was on the basis of the mechanical stratigraphy and the hinterland provenance, the Riskin Committee downgraded the reservoir probability from 60 to 40%. Now, the interpreter was furious, almost shouting match. But we just felt as a group that he was overconfident. And it went back to 40%. Subsequently, several years later, a well was drilled out in the area of B and found a very shaly section with very little sand. Another heuristic is what you see is all there is. Waisatya. So we'll take a look at this. This was for an equity determination. You can see there a vertical well, KN4, downthrown fault trap, beautiful seismic imaging, excellent amplitude response to the sand, a couple of turbidite lobes building out there on the downthrown side of this fault. Now everybody had the same data. We all had to agree on a couple of things. So on the far left, overall porosity is normally distributed. But in one well, KN4, it looked like there was a bimodal distribution of porosity. And that well is in one of these lobes. And so we proposed that indeed, if you're depending on you were in the lobe or not lobe facies, you could get better reservoir developed in the lobe facies. There was a nice response between the net pore volume versus amplitude. The problem is that the function kind of blew up beyond reasonable geological values. And so we, between SSPC and XYZ, we had discussions over what should be the net pore volume cutoff be. Now this became a huge point of disagreement because the geophysics favored the SSP position, which is in to the northeast, and you can see the brighter amplitudes. And we proposed actually that we put a cutoff at 28. Now XYZ said, nope, Wysati, you can't have anything better than what you found in the wells. And they stuck to their guns. We proposed a 28 net pore feet cutoff. They said 16 feet. We went over this for hours. It's very painful. In the end, we proposed in the meeting to split the difference. No agreement could be reached. It went out to arbitration to an executive committee. And in the end, they split the difference as was originally recommended to 22 feet. This was an example of using Wysati to argue a case, and they knew they were wrong, but they didn't have to admit it. So I haven't plotted this on the truth, lie, ignorance diagram, but it certainly plots off the truth and ignorance tie line. Another example of what you see is all there is, we call this at Warwick the orange iguanas problem. Now in this, this class highlights in a way the difference between engineers and geologists. Engineers require a higher burden of proof, in my general experience. So in this, we can see that the goal is to get more knowledge and confidence so we can move up into the bad news and good news occurrence. This arose because we had drawn what we call geogons. They're overlay different geologic parameters. In this case, we've simplified it, but it's basically a GOR from 5,000 to 10,000 to 20,000. And a thickness in here, we also use depth and API, but in this example, I've simplified it. And we had an area that we thought was greater than 10,000 GOR and greater than 300 feet. But there wasn't a horizontal well in it. So engineering came back and said, we don't know how to value that because we don't have any data. What to do? So the solution was just to abandon orange iguanas for a while. The green monkeys was a pretty good type curve. And so we just extended the green monkeys type curve out into orange iguanas and waited for wells to be drilled. And when the wells were drilled, and they were better than green monkeys initially, it went back to being a separate type curve, and all was good. Here's a master template applied to bad news, good news, bad news. We're in a frontier wildcat. It drills 380 feet down dip from a well-defined four-way anticlinal closure. Big closure, 295 square miles. It's offshore. They found 107 feet of gas, pay to base, so it's a gas down tube situation. There's about 735 feet of unappraised rim, possibly oil bearing. So the company goes out and collects some data. We get sidewall cores. There's a little bit of oil, residual oil in some sidewall cores. They get RFT data. The RFT data looks like you could project a gas-water contact. So as a whole, given the gas samples, the dominance of methane over the heavies, the RFT pressures, this looks like mostly bad news for finding an oil rim. So you have to consider it unlikely. And so on the good news, bad news, this kind of moves up. And we'll just say that gas out here is not economic. You're just too far from any market. So kind of bad news. But there's a possibility out there. Now, the truth, lie, ignorance ternary diagram starts to consider emotions. Now, you've got at apexes, you can't quite see the triangle because it's got covered up. But the top is the truth, the ortho truth. It stands the most severe scrutiny. It's rare. Crystal symmetry, statement that production precedes consumption. To the lower left, the ortho lie, it's just a straightforward lie. And it's told knowingly, and it's commonly used by diplomats and politicians. I'd say this is synonymous with alternate facts. And then we have rare, that people admit it, but ortho ignorance, and it's just the willful admission to admit no knowledge whatsoever with no smokescreen. Now within this, because it's got the element of lie, it introduced the idea of emotion and motive in decision-making and presentation and behaviors. So now we can see on the truth, ignorance tie line, that's really the realm of science, engineering. And I would contend that in a way, the truth lie, that is kind of the realm of politics and business. Down below, between the ortho lie and ortho ignorance, that kind of looks like QAnon, between lie and ignorance. So the Maastricht template kind of applies in assessing your confidence, both in people and concepts. Now, I actually found this in a Xerox copy of a paper that I was reading in a library in Oregon. And it fell out, and I looked at it, I said, that's very clever. Now it's about, 1986. And I kept it, and it's been wandering around with me, and I've added to it and thought, but so I don't take credit for inventing this. I've just used it and thought about it more. I really don't know where the original came from, and I've looked for it several times. Anyway, these are just some definitions, and the ones probably the most common ones that I've seen would be the paratruth, epitruth, hemitruth. Quite common, the hemitruth down here. It's common prospect sellers showing only one side of the prospect. Epitruth is when it's common when people will choose only one interpretation, when there might be others to the data. Epi-lie is a lie that has an element of truth with it. You can read through these. Anyway, it's a rather clever way to look at things. So these are those definitions plotted up on the ternary diagram with the six most common occurrences highlighted. Now, let's take a look at applying this. I'm going to pick on Jeffrey Epstein a bit. It's a great book, The Moral Case for Fossil Fuels. He makes a very good base case, but he uses some illustrations that are fairly troubling. Here's one. He shows sea level curves from different places around the world. And it's meant to basically tell us we can't trust sea level measurements and changes. Well, if we look where these are, Juneau, Alaska, active tectonically, Stockholm, Helsinki, and New York, these are all places that still have Helsinki and Finland. They're still rebounding from glacial overload. So you have to take into account what's happening, both tectonically in Juneau and rebound. So this diagram is deliberately misleading, and I think it would fall under a meta-truth or an epi-lie. Likewise, Epstein shows a diagram of on the left of the greenhouse effect of CO2 versus the concentration of CO2. It says, well, the big changes in the greenhouse effect, occur at low concentrations, and we don't have to worry about the amount we're changing CO2 isn't substantially big and it's not going to lead to increasing changes in global warming. However, those lower parts of the diagram, Earth has never experienced CO2 levels that low. So that's a very misleading statement. And once again, it's used to obfuscate some of the arguments and cloud the issue of CO2 and methane contributions to atmospheric and ocean warming. Here's a beauty. A lawyer's ad for induced seismicity. We see the oil up there, there's the rig, there's the aquifer. I've highlighted the little completion thing down at the bottom. Come see us. Now, let's draw that to scale. The guy left out 2,500 feet of overburden. So the level that they're completing these wells is really a lot deeper than indicated in its closest to the aquifer. So this is clearly either a hemi-lie or a meta-truth, but it's an incredibly misleading diagram. Likewise, even the US and GSA, this is from a GSA Today paper on water usage and unconventionals. And there's a nice diagram showing all the activities. But once again, the wells really aren't to scale relative to the aquifer. And if we look at the injection and induced seismicity there with the circle around it, experience has shown in Oklahoma that its proximity to basement that is really a big factor. And this well is way above basement. So once again, this is a very misleading figure to make things look scary, risky than they actually are. And speaking of the truth, lie, ignorance, we've all seen these diagrams. These are the number of wells in a sales brochure in the stack. Really, 40 wells per section in the stack. This is I would classify this as an epi. Quick case study. Here's a case study of the Chukchi Sea, Sale 193 in Alaska back in 2008. 1 kilometer 2D grid. Wow, really dense seismic. Major structures are defined. A couple of them drilled previously. Berger and Klondike. So there we are in offshore Alaska, not too far offshore, about 40 miles. But it is rough, hostile territory. There's a long regional line that was shot. There's been previous exploration. Klondike found a 10-foot oil sand, and Berger found a 107-foot gas sand. Now, there hadn't been a lease sale there in 17 years. Shell had drilled Klondike and Berger. They had previous information, so the company submitted bids totaling $3.5 billion. The highest bid was $100 million for one block, submitted by Shell, the most active bidder. Noticeably absent were Exxon, Chevron, Total, BP, and Hess. You can see kind of the gross bid results. And Shell bid to win. They went out, and they were very successful. They won 91% of the blocks they bid on. They also spent $2.1 billion on this lease sale. Now, I know anecdotally that the technical team had a bid level recommended. It went up to senior management following review. They upped the bid a little bit. It went to executive management, who wanted to win, bid to win, and they upped the bids even further. And Shell left over $700 million on the table in this bid round, although they were very successful, 91% success rate, almost unheard of. Oh, you've seen this before. The master template for Berger, bad news. Low chance of an oil rim. Shell back in the Chukchi Sea. Now, the story is they knew more. They had some geophysical hokey-pokey that suggested that there was a higher probability for the rim. Fair enough. What happens? First of all, they overbid. These should fade in, but clear case of overconfidence. Then in 2010, the big black swan event, the Macondo blowout. This basically stopped all offshore exploration while the feds looked at new rules, reorganized the MMS. They required now a relief rig to be present. Rigs are really expensive offshore Arctic. Shell loses a couple of years. Now, we've got a $2 billion investment running at a discount rate. So this is really killing project economics. They get a drill ship. They lost control of it going through in the Gulf of Alaska in a storm, grounded. It was wrecked beyond repair and scrapped in the Far East, losing an entire drilling season. And finally, in 2015, now they're chasing the sunk cost fallacy. They begin drilling. You drill the top part of the well, then come back in the following year because of pack ice to drill. They got all this done in September 27. They finished the well, and they walked away from all leases after an expenditure of almost $7 billion. So I think for the example, we saw that the Shell case, there was, I think, overconfidence on management's part. There was rare events that they didn't account for. And in conclusion, at all levels, when we look at this, that these diagrams are extremely useful for visualizing and communicating risk. And I'd contend that they can be used for discussions at all levels of decision making. And that's all I have to say about that, as Forrest Gump would say. Thank you very much.
Hey, Andrew, we do have one question.
Okay.
Question is can there be or will there be a copy of this presentation made available later?
Yes.
Something to where they can email you and you can send a copy, or?
The National Weather Service has predicted that dangerously low temperatures will continue through the remainder.
All right. Did you hear that question, Andrew?
It came, there was a lot of reverb.
All right. So question is can or will there be a copy of this presentation made available later? We do. Yeah. We can put this up on YouTube, and so where you can see it, see the presentation. But it sounds like Andrew says that if you email him, he can get you a copy of it.
Yeah. What you might want to consider, because it doesn't cost anything, because there's no page charges, we could actually put this as an appendix in a shell shaker.
Okay. That's the only question we've got. So
yep, okay. I might have to scrub a couple of things off there a bit, but not much.
Yeah, if you have any questions, please type them into the questions box, and we'll get them to Andrew. Andrew, have you found, as you moved into the unconventional space, more acceptance or less acceptance of these diagrams?
I think they're about the same. It doesn't matter. You know, the nice thing about these is that it doesn't matter whether you're in the oil and gas business, whether you're buying stocks, thinking about selling a house, you know, choosing a research project. The confidence and probabilities and the emotions that go into decision making are the same. So they can be applied to conventionals, unconventionals, and all manner of life.
all right, we got a couple more questions. Well, I love your question. But based on those plots, what are investors comfortable with? Can you compare to 10 to 8 years ago when people were spending like drunk sailors?
Oh, well, when I'll wax philosophically for a moment, the whole unconventional realm and the idea of a continuous resource and the perception in the equity markets and the capital markets that we eliminated risk. Hey, here's this, all we have to do is go drill wells. And the exuberance behind that, and then the pressure in companies, this goes back to bias motivation of people's bonuses and stock prices and all that. There's always a tendency to want to have view things more optimistically than they actually are. And it's been borne out that even at Warwick, we discounted a lot of what people were touting as type curves, and we divided by 2, and we weren't conservative enough even then at times for some of the infill that came in, especially the Merrimacian and the Stack. It's a conventional reservoir, micro-Darcy permeability. You get a lot of drainage in it, there's some high perm streaks. So people piled in with money, and it's always interesting when things go out of favor, the money retreats just as quickly. I was asked a question at the Super Basin Conference, somewhat along those lines, and capital will still become available. It'll become more selective, but good teams that have an idea of what they want to do with a focused areas, I think will still be able to go out and gain and have access to capital.
Joel Alberts had a question. How can we train AI or TLI?
How can we train it?
Yeah.
I don't know. You're going to have to ask somebody a lot smarter than me. Ask Chris Bowie, our data analytics VP. It's so subjective.
In terms of software packages, is there anything that does these type of calculations to where something that's out on the market that you can buy, or what is the best?
Yeah. Okay. Well, this gets into when we went at Chesapeake and other people are very popular, the Rose risking software. And it's really, especially for conventionals, a really good piece of kit. In the unconventional realm, my problem with it and the things we haven't been able to do so far is the statistical risking of type curve outcome. And that's really, if you wanted to sample Monte Carlo, you would have a range of B factors and recoveries or GORs in any given area. And then you would sample those outcomes 1,000 times or 10,000 times to come up with a statistical distribution of the probabilities in there. And it's one of my personal problems with the type curve concept is people say, well, that's what you're going to get. No, well, that's the average of what you're going to get for all the wells. And it says nothing about a standard deviation around that average. That would be the one thing I'd like to see improved in how we in software packages.
Okay, thanks, Andrew. Hey, we got another one in here. It says, do you personally believe that the bad news and good news slopes are equal, or in reality, does one favor a steeper slope?
Ooh, and go back to prospect theory in the diagram of how we look at bad news and risk. They probably, in the template, they're even, but in decision making, we always weight bad news more heavily than good news. We also tend to remember whatever happened to us last, which isn't necessarily a good thing. It's like going to a restaurant, having a great meal, and the last bite tastes terrible. You don't remember the good meal. All you remember is the last bite.
Okay, any more questions? Well, I guess
Thank
not.
you,
Andrew, I really appreciate your talk today. It's very interesting. Thanks everybody for staying on and participating. And if there's no other questions or announcements, I guess we will sign off. Andrew, do you have anything lasting comments or anything?
Stay warm, stay safe.
Yeah, I appreciate everybody taking a break and getting on with us.
Get your jabs. Let's get back to what we do.
All right. Thank you very much.
Over and out.
Thank you.